While the news cycle is dominated by daily market moves and central bank chatter, a much larger, more dangerous crisis is unfolding across Europe. It's not a crisis you'll see in the headlines every day. This is a quiet, structural time bomb that will fundamentally reshape global finance, currency markets, and the very concept of Western wealth over the next decade. I'm talking about Europe's pension systems. And no, they aren't just a little underfunded. They are structurally obsolete. They were built on demographic assumptions that are no longer true, and on investment return promises that are now mathematically impossible to keep. You might have seen figures like a $400 billion shortfall. Let me tell you, that's the official sanitized number. The real, stress-tested figure, when you factor in realistic longevity, falling productivity, and the demographic collapse that's already locked in, is over $2 trillion. This isn't just an accounting problem. It's the key to understanding everything from Europe's strange negative interest rate policies to its desperate pivot towards green energy, and even the quiet but massive capital flight from European assets that the world's smartest money started executing years ago. So, what's really going on? European pensions generally fall into two camps. You have pay-as-you-go systems, like in France and Italy, where today's workers pay for today's retirees. Then you have funded systems, like in the Netherlands and the UK, where contributions are invested to grow over time. The problem? Both models are broken. Pay-as-you-go systems need a healthy ratio of workers to retirees. In 1960, Europe had nearly 6 workers for every 1 retiree. Today, it's about 3. By 2040, it will be less than 2. You simply cannot fund generous pensions when 2 people are trying to support 1 retiree. The math just doesn't work. Funded systems, on the other hand, need their investments to perform. Most European funds need to earn 7 to 8% a year, every year, just to stay afloat. In a world where European bonds have paid negative interest and their stock markets have dramatically underperformed, that 7% return is pure fantasy. This brings us to the Netherlands, often praised as the gold standard of pension management. Their massive pension funds, with nearly 2 trillion euros in assets, are constantly teetering on the edge of insolvency. ABP, the largest fund, recently announced it would have to cut benefits for the first time in its history. This is a seismic event. It's like Switzerland abandoning banking secrecy. It's a fundamental breach of the European social contract. If the best system in Europe is failing, what hope is there for the others? What makes this so dangerous is the vicious cycle it creates. To plug the gap, pension funds have only 3 bad options. They can't easily cut benefits because retirees vote and unions are powerful. They can't just demand higher contributions because that crushes wages and makes Europe even less competitive. So they're forced into option 3, chase higher returns by taking on massive risks. Over the past decade, European pension funds have been dumping safe government bonds and piling into riskier assets like private equity, infrastructure, and emerging market debt. This has huge consequences. It inflates asset bubbles, and it means that when a crisis hits, everyone is trapped in the same liquid investments. We saw a preview of this in the UK in 2022, when a sudden spike in bond yields nearly blew up their entire pension system overnight, forcing the Bank of England to step in with an emergency bailout. That was a warning shot. The brutal reality is that this crisis is probably unsolvable. It's rooted in demographics. Europe's birth rate has been below replacement level since 1975. This means for 50 years, Europe has been creating smaller and smaller generations of workers. The workforce of 2045 is already born. Nothing can change that math now. Look at Italy. It already has 170 pensioners for every 100 workers. Its pension spending is 16% of its entire economy. France's recent hugely unpopular decision to raise the retirement age from 62 to 64 was just a tiny patch on a gaping wound. It only delays the system's collapse by a few years. This isn't just a European problem, it's a global one. Desperate for returns, European funds are pouring hundreds of billions into US tech stocks and risky emerging market debt. This means European pension security now depends on the S&P 500 never having a major crash, and countries like Turkey and Indonesia remaining stable. It also creates constant downward pressure on the euro as capital flees the continent. The story of the European pension crisis is the most important financial story that almost no one is talking about. It's a slow-motion collision between demographics, politics, and mathematics, and its impact will be felt far beyond Europe's borders. There's a crisis brewing in Europe that most people aren't talking about, but it could be even more destabilizing than you think. It's not just about pensions, it's about a ticking time bomb threatening the entire European economy. Here's the deal. European pension promises are becoming impossible to keep. Governments are now on the hook, either by guaranteeing benefits or bailing out failing pension funds. This is piling more debt onto countries at the worst possible time, just as their populations are shrinking and healthcare costs are soaring. Take Italy. Its government debt is already a massive 145% of its economy. On top of that, pension spending eats up another 16%. Meanwhile, Italy's population is shrinking, and its economy hasn't really grown since it joined the euro. It's a fiscal trap. To pay for pensions, Italy has to either hike taxes on fewer workers, borrow even more money, or cut benefits and risk massive social unrest. There's no magic fourth option, and the markets are getting nervous. The interest rates Italy pays on its debt are consistently higher than Germany's, signaling real doubt about its long-term ability to pay its bills. If you add its unfunded pension promises to its official debt, the real number could be over 200% of its economy. France isn't far behind. Its debt has topped 110% of its economy, and its pension system needs a 60 billion euro government subsidy every single year just to stay afloat. As more people retire, that number will only go up, pushing French debt toward 140% by 2035. This creates a dangerous doom loop. More debt means higher interest payments, which leaves less money for things that actually grow the economy. Less growth means less tax revenue, which means bigger deficits and, you guessed it, even more debt. The European Central Bank has been papering over these cracks by buying up bonds and keeping interest rates artificially low. But what happens when that support stops? The whole house of cards could come tumbling down. This pension crisis is also secretly shaping Europe's biggest decisions, especially on energy. You might think Europe's big push for green energy is all about climate change. That's part of it, but it's also about cold, hard pension math. European governments know their aging populations can't afford high energy bills forever. With pensions already consuming so much of the economy, expensive energy would crush household budgets, reduce pension contributions, and send the whole system into a death spiral. That's why they're so desperate for cheap domestic energy, even if the economics of renewables are questionable. It's a demographic necessity. The war in Ukraine showed just how fragile this strategy is. When Russian gas was cut off, European energy prices shot through the roof, and the economic fallout was immediate. Europe's dependence on foreign energy is a massive vulnerability, and the pension crisis makes it 10 times worse. This desperation for stable energy is even forcing Europe to compromise on other issues, like its relationship with China. China sees this weakness and is using it to its advantage, investing in critical European infrastructure. European governments are accepting this money not because they trust China, but because they're broke. Their pension obligations have tied their hands. So what does this mean for investors? First, expect the euro to keep getting weaker against the dollar. This isn't a short-term blip. It's a long-term trend driven by money leaving Europe in search of better returns. A euro worth 90 cents isn't out of the question. Second, European stock markets will likely continue to underperform. Companies there are facing shrinking markets and higher taxes. Third, be wary of European government bonds. The market is betting on a smooth, orderly fix to the pension problem. That feels way too optimistic. Political chaos and populist revolts against austerity are far more likely. Finally, there are opportunities. Think about healthcare companies serving the elderly, or robotics firms that replace a shrinking workforce. The key is to understand that this crisis creates winners and losers. If you have any financial ties to Europe, you need a plan. First, if you're counting on a European pension, you should probably assume you'll get 20 to 30% less than what you're being promised. Save accordingly. Second, if you have a lot of money in euros, think about diversifying into other currencies and regions with better long-term prospects. Third, remember that for European politicians, inflation might be the easiest way out. It's less painful than cutting benefits or raising taxes. They can just let the value of their promises erode over time. This makes things like gold a smart hedge. Ultimately, Europe's pension crisis is a collision of unstoppable forces: demographics, debt, and political reality. The math is brutal, and it's not going to change. This isn't just a European problem either. Japan, China, and even parts of the US are facing similar demographic time bombs. Europe is just the first to feel the full impact. The crisis is already here, unfolding in slow motion. The smart move isn't to panic, but to understand what's happening and adjust. Because once you see the pattern, you can't unsee it. Thanks for watching. If you found this insightful, please like, subscribe, and share it with someone who needs to hear it.